You've been warned, as experts suggest, stagflation is coming. I'm your host, Steven Van Metre, and thanks for joining me today. And while experts are ringing the bell that stagflation is coming, you're about to find out if they're right or wrong. Let's head over to Bloomberg, who headlines that the world economy can avoid the 1970s rerun, albeit with some hurt, as central banks learnt inflation 1970s lesson. They're going to do everything they can to slow it. Historic surge in commodity prices after Russia's invasion of Ukraine, coming on top of already high pandemic inflation, has gotten investors and economists searching for parallels with the energy shocks of 4 decades ago and the prolonged slowdowns that followed. The more protracted this period of continuing shocks, he said, the more likely it becomes the economy suffer something like the 1970s experience. And that was what we call stagflation, where you see rising unemployment and rising consumer prices. But is that going to happen again? Well, you'll be surprised to find out. Let's keep going. This is the biggest risk that we might repeat the experience from the 1970s, according to the ECB's first chief economist. And this is the worst combination for a central bank. And he's absolutely right, because what a central bank does through easing or lowering interest rates, they pull aggregate demand forward and it hopes to drive actually unemployment rates down. But when you're in a period of low unemployment like we are now, and you have to start tightening monetary policy, what are you doing? You're reducing demand, and that is the exact point of it. And when you slow demand down, what happens to unemployment? It goes up. So now you've got a mix of high prices and rising unemployment, and essentially the central bank putting us in a stagflationary period. And that's why this is the worst possible outcome for them. Let's continue on, because the weaker economic growth and perhaps even recession may be the price paid for conquering inflation, with emerging economies particularly vulnerable. We've talked about that in the show. We should be more worried about significant deceleration of the global economic growth than runaway inflation, said the former head of monetary policy at the Bank of Japan. And finally, we have somebody who gets it, somebody who's lived through this, somebody who has used extreme monetary policy and low interest rates to find out that you do not get sustainable inflation. In fact, you get the exact opposite. In fact, what he's worried about, what he's suggesting is that if economic growth slows, guess what happens? Inflation slows with it. And of course, the Bank of Japan is an expert on that subject. That is in part because central banks like the U.S. Federal Reserve have learned lessons from the prolonged inflation of the 1970s, enough to preclude going down that dark path again, according to the chief economist at Moody's Analytics. They'd rather push us into a recession sooner than get into a stagflation scenario, and much worse, a recession later. Of course, if you can imagine the Fed actually deliberately pushing the economy into a recession, well, if you're worried about your portfolio when that could happen, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link in the corner and in the description below. You'll be glad you did. Let's keep going, because another key reason economists don't anticipate a 1970s revival is that workers won't be able to bargain up their pay like they did back then. And we're already seeing, as I pointed out in a show this week, that pay is not keeping up with inflation, and that is a big issue. But why did it in the 1970s? Well, in the US and UK, labor unions have shrunk dramatically. Even in Germany, where they play a bigger role, there's caution right now about pushing for bigger wage hikes. That means a repeat of the so-called wage price spiral, which was key in the 1970s inflation episode, is less likely. It also puts households at risk of a big squeeze as incomes fail to keep up with higher prices at supermarkets or gas stations. And all this adds up to a global economy that's more resilient than it was in the 1970s. According to Christopher Smart, who seems like a really smart guy, chief global strategist at Barings, he reckons that any period of stagflation is likely to be short. And in fact, he's absolutely right about that. But the question is, why is he right about brief periods of stagflation when the prevailing view right now is we're going to have high consumer prices for a long time, and that's going to drive unemployment rates up? Well, let's go to the charts and try to figure this out, because we go back to the 1970s where everybody's looking right now. What you can see is in blue, the consumer price index is rising, and what follows, we're using the 4-week moving average of initial unemployment claims. So you notice as prices rise, unemployment claims went up. And then we see it here again in the late 70s. We see consumer prices rising, unemployment claims go up. And so you get exactly what stagflation is like and why we look back to the 70s to see it. But something changed after that in the early 1980s. Let's take a look. Because what happened now going into the 1981-82 recession is consumer prices now are going down. They actually are going down ahead of that. But now notice the exact opposite is happening. We see the initial claims data going up, whereas in the past they were moving in tandem with a lag. Now they're moving in opposite directions. And how about we go into the early 1990s recession? You see a brief period of stagflation where they're both rising, and then what happens? The consumer price index collapses and unemployment claims continue to rise. And how about we go to the dot-com bubble, where again, you get a brief period of stagflation, although consumer prices weren't rising nearly like they are today, but you get a very brief period where you see unemployment claims rising, and then what happens? The consumer price index collapses and unemployment claims continue to go higher. How about the great financial crisis? Again, we see a very brief period of stagflation followed by a further rise in unemployment claims and collapse in consumer prices. So clearly something changed. Well, we only see these very brief periods of stagflation, which we soon could see, and then of course they're followed by an outright collapse in consumer prices. Now, why is that happening? Well, let's go back to the charts and see if we can figure out something that's going on here. And we want to look at the consumer price index versus 10-year treasury yields. And we've looked at this chart before in recent shows, and so you already know that when consumer prices go down, for some reason, yields go down. And this seems peculiar because back in the 1970s, when consumer prices went up, yields went up. And now you understand why so many investors are selling bonds and speculators are shorting bonds. They're trying to get out of the bond market because they're looking back to the 1970s and they see that same thing happening. But it didn't happen afterwards. You see, back starting in the 1980s, that relationship shifted, and it's consistently shifted with each and every recession. As consumer prices go up, yields start to lead lower. And so what is going on here is really simple to understand. Is if we look now at the 4-week average of initial claims, and we take the University of Michigan Consumer Sentiment Survey, and what happens now is when we see sentiment in red go down, what happens is claims go up. So red going down, sentiment going down, initial claims going up. And you see them, and they sort of look like a mirror. Now, they're not exactly that, but again, here you can see sentiment falling, and what is happening is consumers are spending less. So when they're less confident, when you think about this, when you're less confident about your financial situation, you spend more or spend less. And most people, they spend less. And so when that happens, it brings demand down, and of course, that slows and brings inflation back down with it. And it also leads to a rise in unemployment claims, because as demand gets pulled back and spending recedes, then all of a sudden you need fewer people working. Now let's continue on, because there's another slide here that I've got using the University of Michigan inflation expectations. And so what happens is when we see initial claims rising here in blue, inflation expectations recede. So investors get it, or consumers get it. Investors have it wrong, where you see initial claims rising and then inflation expectations falling, which would be consistent with, of course, interest rates falling. So the idea, the whole notion that we're going to enter a prolonged period of stagflation, well, there's no evidence of that, because when we see high consumer prices in our modern monetary system, the globalization that occurred starting in the 1980s, and you have to remember, I was born in the mid-70s, so in the early 80s as a kid, I remember that foreign produced goods and services were literally considered junk. They were subpar, substandard. I mean, you go back and look at the automobiles built then, just as a good example, and even toys. And as I got older, well, what happened? They got better. Foreign produced goods and services got better, on par, and in many cases, even better than U.S. produced goods. So today, we look at foreign produced goods as a good thing. And when consumer prices go up, well, they have a lower cost of production, so they export them to the United States, and that brings down inflation. It's globalization that changed everything. And of course, with that, as consumers pull back their spending, you get lower consumer prices, on top of the fact that we have more inexpensive imports coming in. And with that, all of a sudden, inflation expectations erode. And so the notion that we're going to have any prolonged period of stagflation is not true. what's more likely outcome is we'll have a very brief period as unemployment claims rise, and that will turn right around and head into the next phase, which is after stagflation. Well, that's a recession, and that will cure, of course, any notion of high consumer prices. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only, not intended to provide investor or advice. Here is not to be construed as a recommendation or a situation to buy or sell any security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre, own personal capacity. Opinions expressed in this video that do not affect the Alice Advisors Inc. or Steven Van Metre Financial.